The example before do not have any fair value adjustments at the day of acquisitions. So what happens if we have got fair value adjustments at the day of acquisition? So at the day of acquisition, if the fair value of the net assets is more than the book value of the net assets of the subsidiary, we have to provide for the fair value adjustments at the day of acquisition. And we understand that higher fair value of the asset will attract deferred tax liability. So there will be a deferred tax liability implication. And also higher fair value means there will be higher depreciation in the future. So we may have to adjust for the amortizations, depreciation, and cost of goods sold because of the higher value of the intangible assets, higher value of the property, plant, and equipment, and higher value of the inventory. Let's see an example. On 31st of December 2001, the company acquired 90% of the subsidiaries' outstanding ordinary shares. How much we pay? We pay 8.26 million in cash, and we pay 1 million shares as well. So not only 8.26 million cash, but also the shares with a market value of 5 million. So therefore, the cost of investment should be 8.26 plus 5 million. We can check the financial statements of the parent, and we can see that the investment actually is 13.26 million. Right? Therefore, this investment has been kept at cost. Actually, the parent do not necessarily keep this investment at cost. It can be kept as a fair value through profit and loss or fair value through other comprehensive income. So therefore, if it has been kept at fair value, it may be different from the 13.26. Say for example, if the fair value of this investment is actually 14.26, so therefore it may be kept here as a fair value through other comprehensive income. If this is the case, it will be 14.26. If this is 14.26, the first thing that we have to do is we convert it back to the original cost of investment, because consolidation must start at the cost of investment. Therefore, before we can do the consolidation, we have to credit investment 1 million. If this is a fair value through other comprehensive income, we will debit other comprehensive income and credit investment. If this is a fair value through profit and loss, we will credit investment and debit profit and loss or retained earnings depending on when it happened. Anyway, for this question, it has been kept at cost, so we don't need to credit investment and debit other comprehensive income or profit and loss. The fair value of the non-controlling interest at acquisition day was 1.4 million. So again, we have been told about the fair value of NCI. When the question did not say anything otherwise, we may use the full group method because fair value of NCI is provided. Tax rate 20%, so that means that we have to account for the deferred tax implication. Now, we can calculate the goodwill. How much is the goodwill? Goodwill is what we pay minus what we get. From this question, we have been told that the investment in subsidiary was 13.26 at the day of acquisition. And at the day of acquisitions, the fair value of non-controlling interest is 1.4. So I contributed 90%. Non-controlling interest contributed 10%. So altogether, the 100% of the cost of investment is 14.66. What we pay minus what we get. How much we get at the day of acquisition? So this is the situation that we have. The book value of the net asset, we can calculate it from the equity figures, which is 7.67. Of course, you can calculate the same using the asset minus liability. So assets minus liability equals to equity, so it must be 7.67 million as well. However, this is only the book value of the net asset. The question told us that for several items, the fair value is higher than the book value. Say for example, for the land, fair value is higher than the book value. For building, fair value is higher than the book value. For equipment, the fair value is is lower than the carrying amount, that means there is a fair value reduction. Fair value reduction. For inventory, fair value increment, receivable no change, other current assets no change, cash no change, loan liability no change, other liability no change, but we find a contingent liability. Once we have got the fair value of the contingent liability on consolidation, we will recognize it. So 5 items will have fair value adjustments: land, building, equipment, inventory, and contingent liability. Anyway, when we add together all these assets minus liability, we find that the net assets at fair value should be 8.97. But this is the fair value before we consider the deferred tax. Higher fair value will attract deferred tax liability. So the fair value now is 8.97, book value 7.67. Increase in fair value attract a 20% deferred tax. So the deferred tax liability should be 226,000. Therefore, 8.97 million is the fair value of the net asset. After deferred tax liability, this is 8.71 million. So what we pay minus what we get is goodwill. We can prepare the journal entry. So we can credit investment in subsidiary being 13.26 million. We credit NCI at the day of acquisition, it was 1.4 million. This is 100% of the investment, cost of investment. This is what we pay. What we pay will be eliminated against what we get. At the day of acquisitions, we have got the share capital of the subsidiary. We have got the retained earning of the subsidiary. So we debit share capital of the subsidiary. We debit retained earning of the subsidiary at the day of acquisition. This is the book value of the net asset actually. On top of the book value of the equity, book value of the net asset, there will be fair value adjustments. As I've said before, 5 items will have fair value adjustments. Land, fair value increment. Building, fair value increment. Inventory, fair value increment. Equipment is a fair value reduction. Fair value reduction means we have to credit equipment. And then we have got the contingent liability. So we credit contingent liability. So land, building, inventory, equipment, and the contingent liability. Assuming that we cannot offset the deferred tax asset and deferred tax liability, this is the normal case. So land, building, inventory, the increase in fair value will attract a deferred tax liability. 20% of this 1,820,000, 20% means 364,000. And for these 2 credits, altogether 520,000 will attract a deferred tax asset, 20%. So 520,000 times 20% is 104,000 deferred tax asset. So what we pay minus what we get is goodwill. Goodwill is included here as a balancing figure. So goodwill should be 5.95 million, the same as what we expect. This is the journal entry required at the day of acquisition. If the question only asks for the consolidated financial statement at the day of acquisition, this is the only journal entry. Again, we can make an analytical check reconciliation for these NCI figures. NCI can always be analyzed into its 3 components: book value of net asset, fair value adjustments, and the goodwill component. So therefore, we analyze the NCI figures to the book value of the net asset, fair value adjustments, and the goodwill component. Book value of the net asset, from the question, we know that's the book value of the net asset, 7.67 million. NCI can share 10%. NCI can share 10% of the book value of the net asset. Second will be the fair value adjustments. So we got 1, 2, 3, 4, 5 fair value adjustments. Say for example, for the land, the fair value increment is 390,000. So 390,000 after deferred tax, 1 minus 20% deferred tax, NCI can share 10%. The same for the others. Building, 1.3 million. So 1.3 million after tax, NCI can share 10%. For equipment is a fair value reduction. Therefore, we put a bracket here to certify that this is a negative figures. 390,000, 1 minus 20% tax, 10% share to NCI. Inventory, 130,000 after tax, 10% to NCI. Contingent liability, 130,000 after tax, 10% to NCI. So, land debit, building debit, equipment credit, inventory debit, contingent liability credit. So we have got a net debit on the share of the fair value adjustments. Final item will be the goodwill components for the NCI. So NCI's goodwill is what NCI pay minus what NCI get. NCI pay 1.4 million at the day of acquisition. NCI gets 10% of the fair value of the net assets at the day of acquisition. So what NCI pay at the day of acquisition minus what NCI get at the day of acquisition is the goodwill for NCI. So 529,000. So when we add together book value of the net asset, fair value adjustments, and the goodwill for NCI, this is exactly the NCI figure at the day of acquisition.